You had Warren Buffett who was saying, hey, it does not make sense if you have 50 different investing, like stocks, for example, in your portfolio, and then you try to put some money in stocks 39, and then you're not putting money in your... You don't know about investing and you're starting investing. Most people will tell you, you should diversify. They will say, hey, don't lose money. Investing is, you should not lose money, right? If you don't want to lose money, you should probably diversify, because if one of your investment, fail, drops down, then at least your other ones, right? Your other ones are still here. So you should diversify. But Mr. Warren Buffett here, right? Mr. one of the greatest investor of our time in the 20th century, with 21st is still disputable, right? I think Cathy Wood is making a good case that she might win that spot for at least for the first half of the century. But the 20th century, Mr. Warren Buffett cemented that label as the best investor of the 20th century. All right. But yeah, he's saying it in a nice way. But what he's basically saying is diversification is for idiots. Diversification is for idiots. That's what he's saying. He's saying that, hey, diversification is a good protection for ignorance. Let's figure out why. Maybe he can provide more insights on why he thinks that way.
And value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice. If all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own.
Sheesh, this guy went hard, right? This guy went hard. That's a pretty strong statements to make, right? This guy's like, hey, if you're going diversify, it's a confession. But you want to keep your job, you want to keep it safe, you don't know what you're doing. Now, does that mean you should not diversify? Not necessarily. Not necessarily. And we're going to dive deeper into that as we go forward. He's not the only one who thinks that way. There's also Mark Cuban, who also cashed out from one of his companies, became a billionaire. Now he's also one of the Shark Tank's investor. I'm going to play the next person who has an entire different perspective, who's also a big name in the investing and financing world, right? Mr. Ray Dalio is a hedge fund manager. He wasn't always successful. He was ridiculed earlier because he has a prediction that never happened. And he had pretty bold prediction early in his career. And basically that traumatized him. That traumatized him because he was so sure that his prediction was going to happen. And when it didn't happen, he became traumatized in a way, but that also helped him figure out a strategy to never be wrong again, right? And that's where he started the Bridgewater hedge fund, one of the top 3. But from memory, I think it's the best one in the world right now, as of now. From memory, very successful hedge fund, and this hedge fund is all based on his principle, what he learned on his journey, how he had to change his mindset when he was so sure that everything was going to happen and it didn't happen anymore, and then he had to restructure his mindset and the way that he approached investing to all the way to now that he rise up the ranks of being one of the most successful investors also in the 20th century, right? So now we have 2 heavy heads, right? 2 big names in the investing world with different perspectives. And I love it. I love things like this because now we can understand, we can see different perspective and evaluate that and have a deeper understanding about that main question I asked earlier. Should you be diversified, right? So let me put it back and let's hear what Ray Dalio have to say.
I'm big on diversification.
You're very big on diversification.
Like knowing how to diversify well is more important than almost anything. People don't understand this.
Is that an evergreen principle, you think?
Yes, that's an evergreen principle.
Interesting.
And
it's a name that derives from a plant. There is this plant that always stay green regardless of the season, right? So they call it evergreen. But now YouTubers love to use this term as creating evergreen content. Like, for example, this content that I'm creating right now, I'm trying to apply the evergreen philosophy. And it means it doesn't matter what time it is. If you watch that video 2 years, 3 years down the line, it still will be relatable. It still will be something that you can factor in your decision making, for example. So evergreen, so that you do the work once, you don't have to redo the work all over again. That's where the principle of evergreen comes in the 21st century, right? So that's what he meant by when you were asking the question, hey, is diversification kind of like this evergreen strategy? And he's like, yeah.
Principle,
sure.
you think?
yes, that's an evergreen principle.
Interesting.
And the reason I'm saying that, the way it is, it's almost like a casino making its money. Okay. The way that you do it is you get an edge. So now when you have to make a bet, I've got to bet against the whole world. The world has view on something is reflected in the price. So when I think something is attractive or unattractive, that means I have to bet against the whole world and whether that's right or not. That's difficult. I get it right, more often than I get it wrong, but I'm going to get it wrong sometimes. And so when you can take a lot of different bets, what you can do is like the casino, you'll get your average that your bet would be, but you'll reduce your risk of one of those tables not being the table that's paying off. And so that margin, so I can reduce my risk without reducing my return by knowing how to diversify. And I'd say that's particularly important for the people who are listening, your investors.
Oh, all right. There's a lot that he mentioned here that we need to break down. But so far, totally different perspective. First, you had Warren Buffett who was saying, hey, it does not make sense if you have 50 different investing, like stocks, for example, in your portfolio, and then you try to put some money in stocks 39, and then you're not putting money in your first stock, right? The number one stock that you love. It doesn't make sense. If you know what you're doing, right? If you're not ignorant, you know what you're doing, you should allocate more of your cash into those investments, the business that you think are going to do well, right? Mr. Ray Dalio doesn't see it that way. He see it as a risk management, right? He's seeing as making a bet, which technically an investment is this type of bet, right? You're making a bet and then you could be wrong. So very interesting perspective. And let's see if he has more insight that he can drop on that.
Reduce risk without reducing return.
That's right.
That's the specialty.
That's right.
Elaborate a little bit more if you don't mind on that. So reducing risk without reducing the return, because a lot of times if I'm reducing the risk, it means my return's also going lower. But you're saying, no, we're reducing it without even reducing the return.
Right.
I mean, that's a high-paying skill set to have.
Yeah, that's pretty good to have too, man. Think of it like a business, guys. Let's say you start a business, right? A commerce, like e-commerce. You buy something for $10, you sell it for $20. And then you've been doing business like that for almost a year. And all of a sudden you figure out that, hey, if you go buy that same thing you're selling, instead of buying it in the States, you go buy it in China, you could buy it at $2 and sell it still for $20, right? So your margin is a lot bigger, but the risk is smaller because now you're not risking $10 anymore, you're risking $2. So that's basically what he's saying. He's saying that, hey, what he figured out is he figured out a way to still get that $20 profit, let's say, without having to invest that initial $10. And from that perspective, this is something that I do apply in the philosophy because I create my own philosophies. I don't follow necessarily Warren Buffett philosophy, and I don't follow Ray Dalio philosophy. I have my own philosophy, but the best way you can do that is by learning from people who are successful that are doing it, and then you can take a little bit of their things and then you mix that with something else and you adapt that in your own situation. If you enjoyed this little short segment that we did, here's where you can click to find another short segment, or you can click right here to find the entire podcast. Take care, everybody. We'll see you on the next one.